A memory chip company that filed for bankruptcy 19 months ago just reported gross margins of 78.4%. Nvidia, the most valuable company in the world, is expected to come in at 75.1% when it reports. That gap is not a rounding error. It is a question about where pricing power now lives in the AI supply chain. Friday closed with the S&P 500 and Nasdaq both pushing to fresh records. Apple reported $111.2 billion in revenue for its March quarter, up 17%, with iPhone revenue hitting $57 billion, a March record. The broader tone was unmistakably risk-on. Nasdaq jumped over 1%, tech stocks soared on Apple's earnings, and the week ended with the index posting its best monthly performance since the pandemic rebound. Alphabet had already reported $109.9 billion in revenue, with cloud growing 63%. Meta, Amazon, Microsoft, the hyperscalers collectively committed to over $710 billion in AI spending for 2026. The AI build-out narrative was as strong as it had ever been. And then there was SanDisk. The company reported record quarterly earnings with EPS guidance of $30 to $33. Investors Daily reported it a record high. Jim Cramer went on air and admitted his discipline to sell parabolic stocks had cost him. SanDisk kept rallying 85% after he recommended selling. One analyst on the earnings call asked directly, "Are price increases beginning to slow?" The CEO and CFO held the guidance. The market had not seen a gross margin number like this from a storage company, possibly ever.
SanDisk is not a household name in AI. It spent much of 2024 restructuring after Western Digital spun it off. Its product is NAND flash memory, the same commodity storage that had been crushed by oversupply cycles for years. For most of the last decade, NAND was the part of the semiconductor stack that made no money. That is no longer true. The mechanism behind the margin expansion is a demand shift that most investors have not fully absorbed. AI infrastructure is entering its inference phase. Training phase AI, the kind that dominated 2024 and 2025, required enormous GPU clusters and high bandwidth memory. HBM, the product that made SK Hynix a $100 billion company, was built for training workloads. But inference, running deployed models at scale, creates a different bottleneck. The models are large. They need to be accessed repeatedly, at low latency, in massive volumes. HBM is fast, but expensive and capacity constrained. Standard SSDs are cheap, but too slow. SanDisk has positioned its high bandwidth flash architecture, HBF, as the product that fills exactly that gap. The SK Hynix comparison is instructive. In 2023, SK Hynix bet its entire capital allocation on HBM when the rest of the industry was still uncertain. It became Nvidia's dominant HBM supplier, and its stock became one of the defining AI trades of the decade. SanDisk announced an HBF specification standardization alliance with SK Hynix in 2026, combining SanDisk's 332-layer BiCS NAND stacking with SK Hynix advanced packaging. The product is not fully commercialized yet. Mass production is targeted for 2027. But the current earnings show what happens to margins when a commodity product acquires genuine pricing power before supply catches up to demand. At 78.4% gross margin, SanDisk is not priced like a commodity. It is priced like a bottleneck. There is a condition embedded in that statement, though. SanDisk's margin expansion depends on AI inference demand growing fast enough and long enough to absorb its production before competitors replicate the architecture. Micron is not standing still. Samsung has its own flash roadmap. The HBF Standardization Alliance is SanDisk and SK Hynix attempt to own the specification layer, the same way that lets ARM collect royalties regardless of who manufactures. Whether that works depends on whether hyperscalers adopt HBF as a standard or treat it as one option among several.
The bull case for SanDisk rests on two conditions, both being true at the same time. First, AI inference spending continues to scale at the pace hyperscalers are projecting. The Big Four, Microsoft, Amazon, Alphabet, Meta, have committed $710 billion in 2026 AI capex. If even a fraction of that spending requires the kind of low-latency, high-density flash storage that HBF delivers, the demand runway is long. Apple's record March quarter, Alphabet's 63% cloud growth, Amazon's AWS pushing aggressively into agentic AI. These are all consistent with a build-out that is still accelerating. Second, SanDisk locks in the HBF standard before the window closes. The SK Hynix alliance is a credibility signal, but standards races are won by who ships at volume first, not who announces a specification. The historical parallel that matters is not just SK Hynix and HBM. It is what happened to DRAM pricing in 2016 and 2017 when the smartphone supercycle created a genuine supply crunch. Gross margins for memory producers that had been running at 30% moved to 60% inside 18 months. That cycle ended, as all memory cycles do, when supply came online. SanDisks' 78.4% margins are either the early innings of a structural shift to a new product category or the peak of a cyclical squeeze that will mean revert once Micron and Samsung allocate capacity. The current quarter does not tell you which one it is. The verification benchmark is SanDisk's Q4 guidance call, expected late summer 2026. If EPS guidance holds at or above $30 and gross margins stay above 75%, that is evidence the structural case is intact, not a cyclical spike. If guidance comes in below $28 and the company cites price moderation, that is the cycle answer. Between now and then, watch Micron's next earnings for whether they signal aggressive capacity expansion into the high-density flash segment. The S&P 500 is at record highs. Apple just had its best quarter in years. The AI trade is as crowded as it has ever been. In that environment, the most interesting number this week was not Apple's $111 billion in revenue. It was a gross margin figure from a company nobody expected to be here at all. Whether that number holds is the question the next 2 quarters will answer.